the headlines you see about Indian Airlines placing the largest orders for Airbus and Boeing jets. It used to be that you'd hear that about Chinese airlines and Middle Eastern airlines. Now it's Indian Airlines. As for defense, common thread between India and Europe, where I've also allocated a fair bit of research time, when the government asks, who can we turn to help us be more sovereign with respect to missile defense, anti-drone systems, avionics for fighter jets, eventually the whole fighter jet itself. These countries are not in a position to start from scratch. They have come to realizations as to needing to have a more sovereign military industrial complex, and they want it done yesterday. And so it's very logical that the companies that will be beneficiaries are the ones that have been successful in delivering smaller scale versions of what the governments are seeking.
Today's episode is brought to you by Fiscal AI, the fastest growing equity research platform on the internet. Later on, you'll hear more about Fiscal AI and in particular, what it can do for professional investors. But for now, let's get into it. Today, I'm joined by Andrei Stetsenko of Gymkhana Partners, an investment partnership focused on India managed by Farley Capital. As the name suggests, Andrei's business partner is my dad. In addition, my business and specifically my business partner consults for Gymkhana. Andrei, with that disclaimer out of the way, welcome to Monetary Matters. Good to see you. For people who are not familiar with Gymkhana, tell us about the partnership. What do you invest in, and what's your investment philosophy?
Sure. Thanks for having me, Jack. So Gymkhana has been around since 2017, but we've been investing in India for over a decade, started in 2013. And the opportunity we saw when we first went there over a decade ago was specifically in the underappreciated, mispriced, overlooked smaller cap companies. So our median market cap and average and median are both below $1 billion US. And it's a really rich opportunity set in India. I mean, there's thousands of listed companies and a surprising number of them are high quality. It takes research to uncover them, but that's been our focus. And Gymkhana was our way of creating a separate product that specifically was able to target that opportunity. The results we've been pretty pleased with. We've outperformed every single US dollar denominated India mutual fund and ETF. We've outperformed the Sensex index, the MSCI index. And when I say outperformed, I mean after everything. So the return our limited partners actually get is superior to the return you would have had from holding any of those India indices or India ETFs or mutual funds.
So what are you doing that the big cap funds, the ones that basically the S&P 500 of India, the Sensex or the other big funds, what's the difference in portfolio between those two?
So there's only about 100 or 150 companies in India that are the kind of multi-billion dollar free float market caps that are sizable enough for a product like the India MSCI India ETF to really trade in and out of. And so they're really constrained to a pretty small sliver of the overall universe. The companies we own are completely different. I mean, there's no shortage of companies that are very high quality and large, but everybody already knows that in India. Like HDFC Bank is probably the prime example where every major foreign investor in India that is above a certain size kind of has to own it. It is the best run bank, the most respected. And what we have the benefit of doing is we can move the needle with investments in smaller companies that are, they're kind of the blue chips of tomorrow that we're trying to own today.
So in terms of the size differential, the average company is way smaller than the Sensex. What about valuation?
Yeah. So valuation wise, our forward PE weighted by position is about 15 times. It's way over 20 for any of the indices. For a company like HDFC Bank, it's typically even higher. And I'd say that the other big difference is that our research leads us to assemble a portfolio that looks sectorally pretty different from the indices. It's not like we're deliberately seeking out investments in certain sectors, but we do tend to avoid sectors that are represented by pretty large companies in India, like utilities and telecoms. The Sensex is over 10% telecoms. We're 0 in telecoms. And that's mostly because, we want to be invested in companies that have competitive advantages, related to how they're run and the businesses they're in, not so much the licenses they have from certain parts of the government where we never want to wake up the day after an election and feel like our portfolio has suffered politically.
And so, Andre, so the big indices, MSCI India, the Sensex, like the S&P 500, they actually have a pretty high price to earnings ratio, unlike a lot of other emerging markets. What do you think of the high price to earnings ratio of India? Does it deserve it, relative to the other emerging market sort of children in the EM family?
If my only way of investing in India was holding the Sensex or the MSCI India index, I'd still think that was a pretty interesting opportunity just because uh, what those articles, the India bears that like to talk about the high PE of the indices don't mention is that it's also the only major equity market in the world that gives the US a run for its money in terms of underlying earnings growth. The growth is ultimately what is going to drive long-term equity returns. So it makes sense that the multiples are a bit higher than they are in a slower growth market.
And what is it about the Indian economy, market structure, society where the earnings are growing? Because a country like China, the economic growth has been absolutely tremendous and
Yeah,
super successful in that in terms of GDP going up. In terms of earnings going up, it's been a very, very different story.
sure.
And similar with Europe, earnings have not grown that much, and or Europe has not grown that much overall. What is it about India where the GDP is growing and earnings are growing as well?
Yeah. So first of all, the GDP growth is faster than any of those other places. It's the fastest growing major economy, and the one lesson that's really been reinforced over and over with each visit I pay to India is that the above a certain rate of GDP growth, when your GDP growth is 6% is a bad year in India. When you're consistently growing that fast year after year, the whole structure of the economy is different from what we're used to. I mean, there are sectors in the Indian economy, especially sectors that are catering to, the rapidly expanding middle class that are growing 30-40% year on year. And when the market's expanding that quickly, you just don't get the same dynamics that you do in a slow growth market where kind of there's already incumbents that dominate every niche of the economy. There's a lot more opportunity for disruption and change and for uh, new brands and new businesses to take hold. Um, that's one of the reasons that the equity earnings. I mean, if you look at a chart of the fastest GDP growth by country and also a chart of the fastest equity earnings growth by country, India is the example. Kind of, if you rank it either way, India comes out looking really good. The equity earnings growth actually matches the GDP growth there, and another reason is that it's a lot. It's not a perfect economy. There's problems in terms of some sectors are overregulated, some are too oligopolistic. That's true of just about any large economy. But I'd say that your typical market in India for your typical product, whether it's consumer goods, financial services, is pretty competitive, pretty dynamic, and it allows well managed companies to rise above the rest.
I know you're overallocated, way overallocated relative to the MSCI or Sensex is the chemicals and also the industrials,
Hmm.
agriculture as well. Why is
Yep.
that?
There's a number of businesses, just to tie this into what we were just talking about, of really rapid market growth where the overall economy is growing 6% or 7% or 8% in a good year. Uh, the markets that some of our companies are addressing are growing much faster because basically the addressable market, whether it's farmers buying agricultural seeds or it's young urbanites making their first investment in a mutual fund through a financial services provider, it's businesses that are addressing uh, needs in the economy that are growing much faster than the overall growth, even in disposable incomes. It's happening because uh, their their customers are becoming customers of that kind of business for the very first time. So the growth is just on a different level, and it can continue year after year because people are continuing to move into cities, continuing to get their first formal employment. The kinds of trends that you saw in China maybe 2 decades ago or even longer ago in terms of urbanization just starting to get going. India's majorities of India is still rural. A lot of the trends that powered China's growth back when the Chinese equity returns did match GDP growth, those trends are just getting started in India. I'd say another thing that is pretty important in India, apart from the fact that the business community there also typically speaks English, is just that SEBI, their SEC, is a high quality institution. It's not to say it never makes mistakes, but uh, they're, the rules are strict, the disclosure rules, and I'd say that if you have bad corporate governance, it eventually gets penalized.
Yeah, certainly in the states, we, not nothing's perfect for sure.
Yeah.
So in those industries, chemicals and agricultural.
Yeah, I'd say that with chemicals, you have a multi-pronged opportunity. You have many products where India is currently import dependent, and even if you just look at the shipping costs, it's economical for an upstart in India to start producing it. Even if it costs slightly more to produce it than it would in, say, China or Thailand, they can make up for it by offering reduced shipping costs to the customer. And India itself is such a big market that you don't need to rely on export demand. You don't need to be, a Korean chemicals company that has exhausted its domestic market, so now needs to exploit export opportunities. There's so much opportunity domestically that a company can prosper just based on that. And on top of that, once you get a handle on that domestic opportunity, because Indian companies are so cost competitive in large part because of labor. And when I say labor, people tend to think low cost, but I'm also talking about very cost competitive, higher skill talent, engineering talent, which India also has in abundance. The export opportunity for many of these companies is also, that's another story that's just getting started.
And so when people think of China, I just had on Michael Pettis, and he's really focused on how China's internal demand is very weak relative to its economy. Obviously, it's huge and it's a
Yep.
very big number, but relative to its giant economy, it's weak. In India, that's not the case, right? There is a large consumer market.
Yeah, it's a large consumer market. It's like in the US, the bulk of GDP is attributable to consumer demand. And there's just not the kind of financial repression you see in China, which they've done obviously for their own reasons. But one of the results has been, as we're now all seeing, that it's just kind of stuck in a permanent deflation, and they have to export this massive surplus that's gotten so large that it's now really overwhelmed the rest of the world. Where when you invest in India, that's one of the things that I've been counseling prospective investors when they get worried about stuff like the trade war and the Trump tariffs. Is that stuff matters certainly to certain industries, to certain companies in India, but at the end of the day, it's a story about the relentless growth in domestic demand for just about everything. It's like the U.S. It's an economy that has trade where trade is important, but it's not the end all and be all of your typical company.
A lot of allocators think of emerging markets and they throw everything in one basket. And I think for a lot of countries over the past 15 years have been disappointments. China, Brazil, South Africa,
Yep.
Russia, others as well. How is India not going to fall into that? What traps have emerging market investors fall into in those countries and more? And how are you thinking about why India is different?
You can never act like politics don't exist. And certainly investors in a place like Russia committed that error. I'd say that's also been true of the other countries you named to a less, extreme extent, at least. But in India, Steve and I, we first traveled there right before Modi was elected for the first time in 2014. And even then, we saw the opportunity. And I'd say that even in the absence of a Modi type figure, it would still be a remarkably interesting opportunity. But the presence of a reformist government that, again, like everything else, everything has its flaws, even the good things. But in terms of how uh, the policies of the government have impacted the private sector, it's been a tremendous boon. It's been a tremendous tailwind on top of all the other tailwinds for the past decade to have a government that is aware of the costs and benefits of policies that make it easier or less easy for businesses to function.
And what
Um,
policies have those been for Modi?
One of the big ones is just reducing the complexity of regulation. Uh, it's simplistic, obviously, to just say that regulation is bad, deregulation is good. The way they've deregulated has been smart in that they've uh, taken out of the system some of the kind of complexity for complexity's sake that was introduced pre-91 in India. On my blog, I talk a lot about just what a step change it was in India after 91, where a lot of rules that maybe their intent had been different, but the result had been that they were disincentivizing the growth of businesses beyond a certain point. You see this in Europe now too, where I think it's, I forget the exact number in France, but I think above 100 employees, you have a much more complex regulatory burden. So they have just a completely unnatural number of companies with 99 employees. You had a similar story in India where in an effort to protect smaller businesses, they made it impossible to grow large. And so a lot of those regulations are the kinds that have been dismantled. There's just an effort to um, simplify kind of the day to day of uh, owning and growing a business. And it's been beneficial for the employees of those businesses and, of course, their customers too.
So you said Steve, that's my dad. I remember my
Yeah.
dad telling me probably a decade ago about, oh, Andre's been doing a lot of work on demonetization.
Oh, right.
Explain what that is, and now that we're many years past it, what the impact has been.
You can't really talk about that without also tying it into GST, which, picture India before GST. It was kind of like the US before the Interstate Commerce Act. There were tax collectors, or I guess you could call them interstate tariff collectors at every state border. You couldn't really have a centralized distribution system if you were trying to build a pan India business. You had to have a business in each individual state. It was a patchwork. And the point of demonetization, again, not a perfect policy, probably might have been a more less disruptive way to implement that specific change, which was designed to capture some of the what Indians call black money, illicit, untaxed money in the system. But I'd say the long term result of all the combination of policies that have been pursued, uh, specifically and most importantly GST, has been very beneficial. Where it used to be that many of the listed companies of the kinds we own, they'd face a lot of competition from smaller competitors whose big advantage was that they weren't taxpayers. And you've taken that option, or you haven't taken it away, but you've made it a lot more difficult. Where the way GST is structured, there's built-in incentives to be part of the tax net, so that if you are a tax compliant buyer of products, the suppliers from which you source inputs, they also need to be tax compliant and so on. And so that's been beneficial. It's also been beneficial for equities as a whole, where it used to be that the big advantage of gold and real estate was that you could, it was a way to stash untaxed money pretty easily. And now it's much harder to kind of money launder, essentially. And they're subject to the same rules that financial securities have been subject to forever. And it's been a big benefit both to the financial markets, but also to the country. I mean, because a lot of investment that used to flow into unproductive assets is now flowing into, helping growing companies grow more.
I think a lot of countries around the world that are not the US, I think a lot of wealthy people who have excess savings put it in real estate or into the US market. I don't know
Maybe.
about individual cases, but just looking at the total flows, I think like $700 billion like floated into the US like this year or something. But in India, is that slightly less the case where because the equity market is large, liquid, that they're investing, okay, sure, they'll invest in the S&P and other things, but they invest in the homegrown market as well. Whereas China, it like astounds me how little the Chinese population is investing in the Chinese market.
Yeah. Despite capital controls that make it hard to invest elsewhere. Yeah. So first of all, there are capital controls in India for individuals that, for your typical middle class person, the limits are way above what they would be able to invest abroad anyway. So it really is what you described really is happening, where people have made a conscious decision to put a greater share of their savings in the shares of listed businesses from their own country. And a lot of that has been driven by a 401k type law, or account type, I guess you could call it a systematic investment plan, SIP, where you have payroll deduction funded automatic investments every month. They've been kind of this steadily rising tide in terms of how important they are to the Indian market. They didn't really budge even during COVID. it's been a pretty steady ascent. And at this point, it's something like $3 billion US per month or more. They've become a really important just undercurrent stabilizing the market. And I think it's a key reason why a lot of the foreign investors who, kind of instinctively started pulling their money out earlier this year, the first sign of weaker performance in India, probably were a little surprised when Indian markets didn't buckle. It used to be that foreigners really did drive the flows in India, and that's just no longer the case.
A lot of times, this is just how it happens in financial media. I'll be interviewing like the gold guy when gold's at an all-time high, or I'll interview an oil investor, at the peak of oil prices in 2022. I'm actually glad that I'm speaking to you now because India has been somewhat of a relative underperformer, even though the Sensex year to date up in rupee terms, the biggest ETF by far, has not done that well, underperformed the S&P, underperformed other emerging markets. What is the source of that? You referenced that foreign investors pulled their money a little bit. Why?
Even though foreigners are no longer the primary driver of flows, they still are. It's still impactful what they decide to do, and there have been net outflows out of India by foreigners for most, if not all, months year to date. It's not caused a massive correction, but it's, I think, limited the upside and probably driven a lot of the underperformance you mentioned. A big part of the driver of that, of course, would have been the trade tensions with the U.S. this year. I think that anyone who has been selling India out of fears about tariffs or trade wars, they're kind of they're missing the forest for the trees. Where uh, there are definitely companies and perhaps even sectors that will feel the pain of especially the 50% tariff that's supposedly temporary and should be brought down to 25 if negotiations between the two governments that are supposedly ongoing, if those succeed. But even that 50% tariff, I think, is manageable for the economy as a whole, which is not trade dependent to anywhere near the degree that China is.
You had a report on your blog, Dispatches from India,
Yeah.
about this, saying India is largely insulated from trade wars. Why do you say that?
Well, overall exports to the U.S. are something like 2% of GDP. So it's basically a quarter's worth of GDP growth in a typical year in India. And of course, buried within that number, there's sectors that are a lot more impacted. I mean, textiles is one big casualty that I could name. That's pretty obvious. But the biggest export champions in India, they tend to be in sectors like pharma that are kind of they're more high skilled. They're typically exempt from the Trump tariffs. Number one, and number two, they do a lot of their exporting to places like Europe, other parts of Asia. A lot of Indian companies have big branches, big subsidiaries in sub-Saharan Africa. There's a lot of diaspora links there. A lot of the agricultural companies that we're invested in, they have big businesses in places like Latin America because their particular style of kind of a cost-effective product has done very well there. So part of the story is that India as a whole is not that export dependent. Part of it is that where they are major exporters, not it's typically not utterly dependent on the U.S.
Like so many investors, I panicked too much in April when we had that Liberation Day. With the benefit of hindsight, I now realize like the S&P 500's profits, the lion's share do not come from physical goods exports. It's
Right.
service and the like, which are not impacted by tariffs. Um, is similar true of just the Indian market?
The thing to keep in mind about India is that the majority of the population doesn't even live in a city yet. They're working agricultural jobs that are usually one third or less as productive as even kind of the quote unquote worst job that they would get if they migrated to a city. So there's just this the deep well of continued economic growth, productivity improvements that is continuing regardless of what tariffs are. It's from really simple transformations repeated millions of times over on a massive scale of the population of India, of people leaving a low productivity job, taking a better job, and suddenly having income to spend on things that are not bare necessities. That's the reason why the India economy it seems to stabilize at this fairly high growth rate, even in a tough year for the world.
I hope you're enjoying today's episode. For many investors, financial data from Bloomberg, Refinitiv, Capital IQ, or FactSet is one of their biggest research expenses, with individual seats costing upwards of $20,000 a year. Despite sky-high prices, these platforms have been dominant in the financial data industry. That's because many of the cheaper alternatives don't actually own their data. Instead, these cheaper alternatives are licensing from these big data providers with terms that forbid them from allowing you the ability to download it. For professional investors, downloading and working with data in Excel is a must-have, and this is a major reason that the proverbial Bloomberg killer has been so elusive. All of that is changing with Fiscal AI's new enterprise tier. At less than $2,500 per year, Fiscal AI provides much of the same stock market data at 1/10 the cost of Bloomberg. And you can download it all because Fiscal actually owns their data. Instead of using huge workforces outside of the US to manually input data, Fiscal is using new AI technology to gather data directly from corporate filings, making it cheaper, faster, and more automatic than the labor intensive incumbents. That's also why Fiscal AI's data is updated within minutes of corporate earnings releases. And before you ask, yes, Fiscal does have adjusted forward estimates too. But don't just take my word for it. Start a free trial today and use the link in the description to get 15% off any paid plan, including their enterprise tier for professional investors. Let's get back to today's episode. As we stand here in the middle of December, looking forward to 2026, where do things stand between the US administration and India with regards to tariff? It is so hard to follow.
Yeah.
But broadly speaking, like, is the 50% tariff even going to be implemented?
The 50% has come into effect. So it is applied, but you're right that it's very uneven, the application. There's huge swaths, very important swaths of Indian exporters that are exempt. Electronics and pharma are completely exempt. And so you're right. There's a lot I can say that's critical of the way the U.S. has conducted trade policy globally and with India. And one issue, regardless of how you feel about whether tariffs are beneficial or not, is just the inconsistency and unpredictability. So it's very hard for companies to plan. Um, and I'd say that another thing, just speaking to my Indian friends, is there definitely is a lot of confusion as to what it is exactly the U.S. wants. It's kind of widely known, if not maybe publicly spoken, that the U.S. administration basically demanded that India go along with something that wasn't true, which is that Trump brokered a peace agreement with Pakistan. That's not an accurate description of what happened, and there's a sense in India that even though ostensibly the reason for the punitive additional 25% tariff is purchases of Russian oil, the real reason is kind of a bruised ego in the White House. So there's a lot going on in terms of the underlying drivers and what could be done diplomatically to heal the rift. But I am pretty confident that whether it takes another few weeks or a few months or even longer potentially, the kinks will be ironed out because it's the most important, I think, diplomatic relationship in the world behind U.S. China. It would be very bizarre for the two biggest democracies in the world, both of which are concerned about China, to not be working together.
You mentioned defense. What drew you to the aerospace and defense sector in India, and how is it different than Europe and the US?
The first thing you notice traveling around India a lot, and it's pretty sweet when you witness it, is there's a lot of first time flyers in the airports, on the airplanes. People who are very excited when the plane takes off, when the plane lands. It's a quintessential example of what I was referring to earlier, where someone the per capita income going from $3,000 to $4,000, that conceals a lot of momentous change that's happening on the human level, where someone might be going from a job that pays them enough after their necessities to buy maybe a movie ticket. Suddenly they have enough money to spend to buy a plane ticket for the first time, because the amount of income they have left over after paying for necessities, that number is growing much more rapidly than their overall income, if that makes sense. The domestic aviation market is an example of something where demand is just exploding. India was the eighth largest aviation market a decade ago in the world, and now it's third, just behind the US and China. And per capita flights are still a fraction of what they are in just about any other major market. It's less than zero point 0.2 a year, whereas in the rest of the world, it's multiples of that. So that's on the civil aviation side. It's what I just described, all those powerful trends. That's what's driving the headlines you see about Indian Airlines placing the largest orders for Airbus and Boeing jets. It used to be that you'd hear that about Chinese airlines and Middle Eastern airlines. Now it's Indian Airlines. As for defense, there's an interesting commonality between what you see in India now and what you see in Europe, where obviously the European aerospace defense stocks have also been on a run. And the geopolitical reasons for that in Europe are pretty obvious. But in India, what's happened is that they've seen what happened in 2020. There was a border scuffle with China. Everyone saw what happened earlier this year with Pakistan. And Indians have also been paying very close attention to how the US has been treating its partners. And I think there's a growing awareness that regardless of how things go in the future, that it would be, it's a strategic necessity to have a sovereign and self-reliant defense industry. And so I think that the what we've heard over and over again from CEOs of defense aerospace companies in India is that the government gets it now, that they understand that to cultivate the kind of defense industry they want, they need profitable private companies to be able to invest in R&D and capacity expansion. And it's a sea change from how things were a few years ago.
I'm curious about the defense, but just sticking with civil. So the Indian aerospace market and the airline market is in enormous secular growth. Okay, that is probably a sufficient but not a necessary condition for good returns because you
Yeah.
have to have a good industry. China has a huge secular growth, but capital returns have been very weak. You know, Airlines, as Warren Buffett said, has historically been a very, very tough business.
Yep.
Make the case for why you found them to be durable compounders that have a protective moat.
We have not invested ever in Gymkhana in an airline. The world would have to change pretty dramatically, I think, for us to ever consider that. The investments we've made in the sector, they've been some of the companies are, like you said, they're suppliers to the duopoly of Airbus and Boeing, and the things they're supplying are usually pretty complex. They require one of the reasons that the business has come to India is because India has this wealth of low cost labor. But another big reason is the one I alluded to earlier, where India also has an abundance of highly skilled engineering talent. And so you can get in India a reliable and cost competitive supplier that nonetheless is delivering you a quality product that's comparable to what you used to be doing in house. It's the reason why it's not just Airbus, it's not just Boeing, but even European companies like Dassault, which has never produced before aircraft outside of France. They are now in the early stages of planning to do just that in India. There's all these reasons that I just mentioned why India is a good candidate to be a multinational production hub. But you also have a massive addressable domestic market where if you're Airbus and you are thinking about where to site, where to give out contracts, where to build your supplier base, India makes sense for so many reasons. And a key one is that if you're expecting a lot more orders from Indian Airlines, it'll be helpful to have more of a base in the country.
Tell me about these types of companies that you're investing in that are suppliers to these airline companies. Give examples if you can.
They're not typically suppliers to airlines themselves. They're suppliers to um, either companies that make plane parts or that are repairing planes. So the MRO, maintenance, repair, and overhaul market, that's a huge opportunity. There's a company we own called Sika that active in that space. There's another company we own called Unimec that makes mission critical tools that are used in MRO applications, but are also sold to notably to the makers of aero engines. So Safran, GE, Rolls Royce. It's the most important machine apart from the plane itself, and it requires a lot of ongoing maintenance. And so that's a great business because you kind of the whole business is spares and extra parts. The maintenance is the business. Once you get in and once you're an approved vendor, you're locked in for decades, and you're usually a very small part of the cost structure of the end product. And so your customer is not nickel and diming you. If you put yourself in the shoes of an Airbus or a Boeing, each one of those companies is producing a few dozen planes a month. both want to scale up production, and both know that they have thousands of airplanes on order. Their order books are filled up through the next basically a half decade or longer. And so what they're trying to do is not just, patch in some Indian supplier to take over some existing business. They're planning for growth. And so when they approve an Indian supplier, they're counting on them to grow with them, and to help be a reliable partner, who's not presenting them with issues, who's not the reason that they have to cap production in a certain month going forward.
When you visited some of these companies last month in
Yeah.
November, and they're looking at a photo right now of a prototype for Dynamatics drone. What was
Yeah.
it like? What did you observe?
Yeah. So Dynamatic is a fascinating company. I remember Steve Nuriksha is our India based analyst. The three of us, we left that meeting feeling like this company was, we're not sure exactly what it will look like and what the Indian aerospace industry will look like 20 years from now. But we have high confidence that this company will be a part of that story where, they're kind of at this point, they have such a good reputation as a reliable and high quality supplier to just about every one of those Western companies that I mentioned earlier, Airbus, Boeing included, that they have their choice of the business they want to take. That they when they build a plant, it's just a question of which customer is going to be taking the production off that line. There's no shortage of potential business for them to tackle. They just want a contract to supply all the doors for all Airbus A220s, I believe, worldwide. So there's just a massive opportunity to keep winning business like that both scales them in terms of providing an additional Indian supplier base to match the Indian demand that Airbus and Boeing are now having to supply, but it's also making them an export engine.
And tell us about Sika.
So Sika is another interesting company. Then we should also talk about defense because a lot of these companies are tied into both opportunities where, Sika is, they have multiple businesses, but the most interesting one, the fastest growing one, the driver of the company's overall growth is their MRO business. It's a lot of overlapping providers from, when you look at an aircraft, whether it's the landing gear, the seats, especially if we're talking about just non-economy, but more complex seats. Those are typically complex machines, and everything has its own complexities, needs its own specialized maintenance. And so, what Sika benefits from is this web of licensing, authorized provider agreements with all the different companies that supply, especially Airbus jets, which to date have been most of their business. So, um, they should be able to grow at least in line with the rapid growth in Indian MRO, where most Indian jets currently, most of the maintenance work is done outside of India. And so there's an opportunity, not just from the rising air traffic in India, but also from the kind of repatriation of that maintenance work as Indian companies gain the ability to handle more of what currently would be performed in the Middle East or Europe.
And so Sika had been on, quite a heater year to date, giving back some of those gains. But when you see a stock surge so much, do you get a little bit nervous? I'm looking at the trailing PE right now is 57.
Yeah.
How are you thinking about that? I imagine it's probably one of the more expensive stocks in the portfolio.
Sika is also a very interesting example of, I don't want to give away too much of the secret sauce, but the PE you see on Bloomberg or on the internet is not how we think of the valuation. There's let's just say that there's something on the balance sheet that, we think has tremendous value, that's probably worth at least a chunk of the current market cap. It's not the reason we're invested, but we feel like it gives us an additional margin of safety when we think about PEs. And yeah, I'd say that we'd love to, I'd say our median holding in Gymkhana does not trade at that kind of multiple of trailing earnings. And it would be incredible to be able to buy these businesses at 10 times earnings. I think that sometimes with some um, growth opportunities in markets like defense and aerospace, where I think where we're disagreeing with other investors, where we're kind of the reason we have a different mindset from the people who are selling us shares in these companies is that we really we believe there's reason to have great confidence that the kind of growth we've seen in recent years will be sustained for a long time to come, and that it'll be really high quality growth. A good example that comes to mind is a lot of the aerospace companies I met with. They might have had a multi-year relationship with, say, Airbus, but not with Boeing, or with GE, but not with Safran. And they would have been doing some small test level business with whichever one they were trying to get into and establish a relationship with. And so they basically would have a whole line of their business that's not really profitable. It's just about getting into the vendor ecosystem of that potentially huge customer. And as they scale up those relationships to be fully fledged commercial relationships, the potential earnings growth should be uh, there's a powerful driver yet to come. Is what, I guess what I'm trying to say for many of these businesses, where it's not like they'll struggle to continue growing at a similar rate. They might even accelerate.
And so, Andre, the market cap in dollars of Sika is just under a quarter billion after its meteoric rise. Tell us about in India, are there IPOs that are very, very small in market cap? Because in the US, a lot of the time that a US stock is at $70 million market cap is because it had a market cap of $1 billion and it's a total loser of a company.
Yep.
Whereas in India, it seems like there are smaller IPOs.
Yeah. So there are a much wider range of companies that you still get your big blockbuster IPOs, but usually those are much more like the ones you see in the States. It'll be a company that's SoftBank or some huge private equity firm is offloading something. That's kind of your quintessential US IPO, where um, in the worst of those examples, it's something that private equity just has to get rid of because of their own internal timeline in terms of the life of their funds. It has nothing to do with kind of the quality of the business itself. And you see much less of that adverse selection in India, where the companies, of course, there's duds, but many of the companies going public are, incredibly exciting growth stories that really are. It's kind of the exact thing you would think of reading an economics textbook as to why companies would do an IPO, where they want to get on to that next stage of growth. They need to fund their next big factory. It's not about, a current big shareholder just wanting to monetize a stake.
That makes sense. So, Andre, all right, we talked about civil aviation. Tell us about defense.
Yeah. So with defense, you see a thread, a common thread between India and Europe, where I've also allocated a fair bit of research time, just looking at the companies that are poised to be the answer to their respective government's question when the government asks, who can we turn to help us be more sovereign with respect to missile defense, anti-drone systems, avionics for fighter jets, eventually the whole fighter jet itself. These businesses, these countries are not in a position to start from scratch. They have come to realizations as to needing to have a more sovereign military industrial complex, and they want it done yesterday. And so it's very logical that the companies that will be beneficiaries are the ones that have been successful in delivering smaller scale versions of what the governments are seeking. It's a multi-layered array of growth drivers for these companies. You have the rise in the overall defense budget. Usually there's a big push to increase the share of those funds that's being allocated to equipment purchases rather than salaries and pensions. In increasing these budgets, they want to see surely more sovereign capability with respect to specific systems that they'll be able to operate and deploy. Within the equipment budgets, there's usually a push to allocate a greater share of that to more nimble, smaller companies that are able to, deliver a working system in, a couple years rather than in the typical, almost decade-long type timelines that you see with some of the larger contractors, where, India has a version of what we have in our country, where there's these incumbent titans of the defense industry like Lockheed, which they're indispensable to the structure of the market the way it exists. But I think there are some voices in our country that are saying a lot of the same things I hear in India, where they're saying, well, why can't we have a drone system or an anti-drone system that doesn't take a decade to develop. Why can't we have something that's maybe lower cost and not as invulnerable to every possible threat, but we can produce thousands of them?
I imagine the people who are, saying, "Oh yeah, we have the future of what weaponry, buy from us." Basically, I imagine they're focusing on drones. Like with warfare right now, what actually matters in the wars of today and tomorrow. Hopefully there are very very few of them. And what is kind of an antiquity, like I don't know, maybe I don't know, is it tanks that or something that the generals are still buying because they're 70 years
Yeah.
old, but no one really needs to use them.
Yeah, so I'd say one thing that the Russia's war in Ukraine has showed is that drones are way more critical than anyone thought. Um, Tanks are a lot more vulnerable than anyone thought. Um, and one thing that you see in India as a reaction is that, like you said, there's inability to give up what they're used to. So the army still relies, for example, on a large number of motorized vehicles that they get produce or import from Russia or produce in partnership with some Russian firms. And but that used to be kind of the MO of the entire Indian military. That's now an exception. So the Navy and the Air Force, they're really they're the ones that are driving both the indigenization that we're seeing, where there's a push to make in India things that they used to rely on foreigners for, but also on partnering with new partners. So not Russia, but rather Israel and France and the U.S. also to both import technologies that the Russians can't offer, but also to bring to India some of these technologies over time.
So India had been a significant buyer of Russian arms. Now that's declining, and they're
Yep.
buying it from elsewhere and also trying to produce within the country. So I'm going to mess up the word, the indigenization of
Yeah.
Indian weapons. Tell us about that and what kind of economics could it create?
It used to be that India would, for example, in fighter jets, would buy an entire Sukhoi jet from Russia, and the Russians. That's not just a commitment to buy the jets. That's a commitment to buy servicing and maintenance parts from for decades. It's a big commitment. What the Indians are trying to shift to, so their current big partner, at least with respect to fighter jets, is France and Dassault Aviation specifically, which produces the Rafale jet is they've been happy or at least content today to buy these jets made in France with French Safran engines. But what they're increasingly moving towards as they gain heft as a really significant export customer for Dassault is to say, okay, we want to the extent we're going to order another 100 planes from you, we want a big chunk of that value to be created in India. We want you to transfer us the ability to uh, create at least, for example, the aero engines, to maybe one day start doing the wings and the flaps and, moving towards a future where eventually India will have its own capability to produce a stealth jet fighter.
And what is it about the current state of airplanes that they take so long to produce? That it didn't take that long in 30 years ago or 70 years ago. Is it just that they're so complex? Is it the bureaucracy, or is there some other reason?
It's all of the above. I mean, they're flying computers, and so the software is tremendously important. I think that the projects that have had the fewest complications have tended to be the ones where, from the very beginning, they were conceived as an adaptable platform. So it was less about, this fighter jet hardware is only compatible with this very specific software that has to integrate with the fighter's helmet. And if there's one issue with any of it, you can't swap it out. Those kinds of setups have led to problems. Whereas what customers increasingly are demanding across the world is something that is both deliverable faster and where there's just more flexibility in terms of swapping out components and vendors.
So, Audrey, tell us about some other companies Gymkhana has invested in the aerospace world in India.
Yeah, so we talked briefly about Dynamatic. We talked about Sika. One other interesting category and an example of a company in that category would be DCX, where it's uh, when India decided that they wanted to indigenize their defense procurement, uh, kind of their bluntest, most obvious tool for doing that was to simply require a rising share of content to be sourced from Indian vendors. And so it used to be 40 or 50%. Now it's a typical percentage for a contract from the Indian military is closer to 60%. And that's been a big boon for companies like DCX, where, uh, for example, if you're Boeing or you're Lockheed and you want to sell F-16s to India or newer aircraft, you can do that. But for example, the wiring, the hooking up of all the electrical components, that's a pretty labor intensive and a pretty important piece of the overall work. That typically now gets done in India by a company like DCX. And so uh, you'd think that it would be a pretty straightforward business. Why aren't there a lot of companies doing that if the government's basically giving them this market? But reliability, speed matters a huge amount. These companies, it only takes one accident, one mishap to really damage the reputation of their products. And so they are very reluctant to go with any vendor that they have not spent years and years testing and evaluating. And so the ones like DCX that have already gone through that process and won the approval of these foreign defense partners that India is cultivating, they're in a great position to continue winning more and more business.
And you've written about how India is targeting a certain level of profitability for these providers, right? Because if the profit margin is zero, it's going to be very hard to build things in India.
I should clarify that. It's not like the government has gone out and said, we want, industrialists to be tremendously wealthy and have vacation houses. It's more along the lines of there's a realization that there is no way to build this dynamic private sector defense ecosystem without allowing companies the level of profitability that will enable them to invest both in building new plants and in R&D, the kind of R&D that'll allow India to be completely self-sufficient, in a couple of decades in terms of even the most advanced products. And there's an increasing awareness both of that and of the necessity of working directly with some of these smaller, nimbler private sector companies where India, I mentioned this earlier, like the US, has this kind of incumbent aristocracy of defense contractors. In India, they happen to also be state controlled. Bharat Dynamics, Bharat Electronics, and Hindustan Aeronautics are the big three. And you can imagine that there's a pretty cozy relationship between the government that's ordering the weapons, the state controlled companies that are for decades have dominated the production and delivery of those weapons. And so it's been a really big deal to have broken through that very cozy relationship. And that really has been happening with the Modi government, especially within the past couple of years. I think there's been a really renewed sense of urgency from those two border conflicts I mentioned with China and with Pakistan, and with viewing the performance of Russian equipment in Ukraine. I think there's been in the defense establishment this kind of realization that it's not enough to just keep doing things the way things have been done, and it's okay if the new, more efficient way of doing things, if it's not exactly what that incumbent trio, if it's not what they want, it doesn't matter. We should be doing what's good for India.
And tell us about the level of severity of the conflicts between India and China and India and Pakistan. I know as much as Mexico and the US might butt heads politically, or US and Canada, we're not worried that Mexico is going to invade
Yeah.
us, and really neither is vice versa. But I know India and Pakistan, there's a very deep history there. India and China, like, is there a real risk that China is going to encroach upon India, or is it kind of just saber rattling?
All three countries are nuclear powers, and so no one hopes for a war uh, among any of those three. And I don't think a big land war among the three is anyone's central probability scenario. What the risks that India wants to be able to tackle is that they want, at the very least, to be able to really effectively monitor their borders with these countries. Keep in mind that the border with both countries, especially China up in the Himalayas, is very rugged terrain. It's very mountainous. And so the equipment that you need to accurately track anyone attempting to encroach on any little part of that has to be pretty sophisticated. So a lot of the companies that we met with last month, they're suppliers of, uh, I guess you could a catch-all term for it would be electronic detection equipment, just stuff that enables a better picture of the world, and not necessarily just the battlefield, just border control. Um, and yeah, I'd say that with respect to Pakistan, that really is a great. If you look at the two countries' GDP per capita, it really is a great illustration of the power of liberalizing economics. In 1991, Pakistan had a higher per capita income than India, and now India is just completely shot out of Pakistan's league and is able to spend 9 times more on defense, despite not spending more as a percentage of GDP. With China, of course, it's a much bigger challenge. China is able to outspend India on defense, and so that's where I think Indian leaders look and say, we have to be able to do stuff in a cost-effective way. And again, that's another reason to turn to these nimble private sector players.
Turning away from defense, so Gymkhana Partners has a website, and then you also have a blog, Dispatches from India. You've been
Yep.
writing for many years. You recently had a write up about Maharashtra Scooters.
Yep.
What is Maharashtra Scooters? What do they own? And tell us about this sort of holdco dynamics for that company, as well as other companies that you and my dad see as quite attractive to investors who can track that and know what they're doing.
There's a number of reasons why these holdcos in India came about. I'd say the most typical, the classic story, backstory to one of these would be that there was an industrialist 3 generations ago who wanted to pass down his, and it was all men back then, wanted to pass down his empire to the next generation. And in some in cases, you read about business disputes or conflicts in the newspaper. It's usually about an industrialist who failed to do this. And so there's a dispute at every generation when it comes time for inheritance as to which cousin gets what business and what's equitable. With a holdco, you get rid of that problem. You basically just hand everyone shares in this one thing that's like a family trust. And over the generations, the biggest ones, the most successful ones like Bajaj and Godrej, they've become very valuable and very diversified. And so Maharashtra Scooters is the second biggest holdco in the Bajaj web of companies. And Bajaj Holdings, we used to own until we discovered Maharashtra Scooters and realized that both holdcos are a collection of very high quality businesses, but Maharashtra Scooters allows us to own those at an even bigger discount.
So in the biggest India ETF, Bajaj Finance is, I believe, the ninth largest holding, so let's say within the top 10 holding. And you had owned that, but now you own Maharashtra Scooters, which is a holdco which owns Bajaj Finance, I just mentioned, but also Bajaj Finserv, Bajaj Auto, Bajaj Holdings. So it just owns those four things, and that's all it does.
It's all it does. Yeah, it's not you're not buying into like a John Malone type operator who's going to take your capital and suddenly reinvest it all into Formula One. These are diversified businesses that are there. It's kind of like owning a passive investment vehicle at a huge discount to NAV, where Maharashtra Scooters trades at less than half of our calculation of NAV, and the NAV isn't stuff that's cheap indirectly because it deserves to be. It's companies like Bajaj Finance that you just mentioned, which are leading fast growing businesses that are capitalizing on really powerful um, growth markets in India, like financial services.
So if it's cheap now, it must have been enormously cheap 10 years ago.
When we initiated our position in Maharashtra Scooters, it was definitely the multiple of underlying earnings was closer to 10 than to 20. It's still pretty cheap. I mean, the 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 point of our investment there is not the exact indirect PE we're getting through the holding company. It's the point of it is that we've identified a very high quality collection of businesses that we'd like to be shareholders in. And we've identified a way to do so with a greater margin of safety. So rather than buying the underlying businesses directly, we buy this listed vehicle that owns shares in them that's trading at a discount. And so we effectively are paying a much lower PE than we would buying directly.
Looking at the holdings of Gymkhana, a lot of the very interesting cases are in the financial sector. But why is Gymkhana's allocation to financials lower than in the Sensex and MSCI?
Part of it is that Some of the businesses that are easiest for foreigners to understand are ones like HDFC Bank, which we mentioned at the start of this conversation, where let me check what the current PE is, but it's historically been absolutely bonkers. I remember at one time HDFC Bank traded at 9 times book. It's a very high quality business, but and it's one of the reasons that the allocations of the index to financial services is so high is that the way they get exposure to financial services is through that kind of business that I won't call overvalued, but I would say very fully valued. And so they're paying very large multiples for a company that's not qualitatively any different from the financial services companies we own. Certainly not qualitatively better, and the ones we own are have we believe a much longer runway for rapid growth than these incumbents that already are dominant in their slice of the financial world. So, an example would be one of our biggest holdings is a company called Colomandalam Financial Holdings, and so that trades at a big discount to NAV. The biggest single piece of which is a company that also has the name Colomandalam in its name, Colomandalam Investment and Finance. And it's basically a financial supermarket that's especially dominant in southern India and some of the most prosperous parts of the country. I remember meeting with management and just leaving that meeting, which with exactly the kind of feeling you want after meeting with a financial management, which is they're not pursuing growth at any cost. They understand that the point of a financial business isn't about lending out money; it's about collecting money. And they're very flexible with respect to the kinds of businesses they want to be in. That's completely dependent on the market opportunity. They're not trying to build an empire; they're trying to grow earnings.
You said it's a financial superstore, so I imagine they do everything. But in what are they particularly strong, and why are they? What are their competitive advantages?
I should specify we don't own that stock directly. We own it at a huge discount through an undervalued HoldCo.
Okay.
So that's one part of our thesis. Another is that HoldCo owns stuff that isn't just that one stock. And so we're getting a diversified kind of mini portfolio within our portfolio of businesses that we're getting at an indirect, much lower multiple than the headline PEs. And I'd say that why, what's the rationale for someone who is choosing to pay that multiple directly? I don't think that's an irrational investment at all. I am very happy to have a way to get at it indirectly at a much lower PE, but someone buying it directly is investing in an operator, the Colomandalam Group, which is the umbrella for the family group that it's under is Murugappa. I'd say Murugappa and Godrej and Bajaj are probably the top three names in terms of reputation of both management and ethics in India. So they companies that are part of those groups, they usually trade at and deserve premiums.
And so, Andre, obviously, if you can buy an apple for 20 cents instead of 30 cents, it's a good decision to do it. But when you're making these allocations, I presume to a more illiquid holdco that you are basically getting a bargain. What's your investment thesis? There are a lot of investors who buy the undervalued closed-end funds and then short the basket that they own to harvest that premium. You're not doing anything like that. But do you have a thesis for convergence, or is it just you like buying cheap things?
Part of it is that given the option, we'd rather buy an apple at half the price, everything else being equal. It's just a bigger margin of safety. But with these stocks, the listed holdcos in India, there really are a bunch of catalysts emerging that, it is not our thesis. Our thesis is not dependent on these discounts closing or even narrowing, but there's ample reason to believe that they will continue to narrow as they've started to over the past 2 years. And I'd say the most important reason is that SEBI, the Indian SEC, has taken a very constructive position and a very active position that really shows that they're aware of these discounts and that they feel that the continuation of listed companies trading at 50, 60, 70, or even greater percent discounts to their NAV is something that at the very least they should try to highlight to market participants. And so there's been a bunch of moves to both do that and to make it easier to realize value in these structures. And so these companies gained the ability as of a year or two ago to distribute without adverse tax consequences their shares and other listed companies to their shareholders. And so if you're a holdco, it suddenly is now possible where it wasn't before to dividend out again without adverse tax consequences to basically give your portfolio to your shareholders to remove yourself as an intermediary. And I don't necessarily expect any one particular holdco to suddenly do that. What wouldn't surprise me is if a setup like Bajaj, where you have multiple holdcos, if there were one day a headline about a simplification of that structure, where instead of two, we're going to have one. And Maharashtra Scooters would be perfectly positioned for that because its largest shareholder is another holdco. So it would be incredibly accretive. It would be a win-win for everyone, for the shareholders in Maharashtra Scooters to basically get effectively a premium to their current undervalued share price paid for by shares in the slightly less undervalued holdco that already owns most of Maharashtra Scooters.
Who is your competition in India?
On a big picture, zoomed out level, the competition is a lot greater in terms of just overall foreign interest in India, where when Steve and I first went to India, it was very common that we'd be the first foreigners visiting a listed company. That still happens. We're still very excited when that happens, but it's become rare in part because the opportunities become more obvious to people, and so now you have the Quebec pension fund is suddenly has a dedicated team doing India investing, which didn't used to be the case, of course. But within our niche that we've carved out of these smaller cap, high quality businesses that we uncover based on intensive fundamental research, I don't see a lot of competition there, even to this day, where I think we've built up, I'd like to believe that we've built up a moat just by having accumulated the research that we have accumulated, where we are familiar with the reputations of just about any big name in India, any medium sized name in India, in terms of ethics, corporate governance, what companies were they involved in before, what do their customers and suppliers say about them. We like to leave a little time at the end of every company meeting just to chat with managers about what they think of this CEO, what they think of that controlling shareholder. And you add up enough scuttlebutt and you get a really, really valuable database that we've compiled of something like 2,000 companies where we've recorded basically every data point that could be impactful with respect to their reputation and how they conduct business and what the counterparties they deal with and the companies they compete with, what they think of them. And that's a very useful tool when it comes time to screen for corporate governance. And it really helps inform what companies we try to meet with next. So it is more of that virtuous cycle I was alluding to earlier, where the work we've put in to date, I've been to India, I think 18 times now, that the work we've put in over the course of this decade plus of trips is immensely valuable in making sure that each time we come back, our time is spent even more optimally and productively. I think that the results of our really research intensive approach, they've been borne out in our performance, where you can go to gymkhanapartners.com and see every detail of our track record, but we've outperformed the Sensex, we've outperformed the MSCI India index, we've outperformed the comp set of over 50 India mutual funds and ETFs that we track and compare ourselves to. And I think that that's not just luck, at least a part of that is a replicable strategy or a strategy that we've pursued that we want to continue replicating as we invest for our next decade in India, where if you put in the work, if you do a lot of very fundamental research to screen the investments you make, and then very importantly, if you're a patient investor, you can get a lot of long-term alpha in India, where the great thing about the Indian market, among the many great things, is that a lot of the people who you have the opportunity to sell stock to and buy shares from, they're very short-term minded. And so you are able to buy from people in a moment of panic where they're just ditching shares in a business that has a great long-term potential. And by the same token, during moments of euphoria, we've been able to part with our shares to people who I wouldn't say they're necessarily overpaying, but they're paying very exuberant multiples for businesses we were able to buy into at much lower multiples.
So, Andre, what are some stocks or sectors within the Indian market that you are bearish on or see some challenges for? You already mentioned like the telecom companies that are heavily reliant on government contracts and the like, but what else?
I'd say that there's cycles in India where certain things are very hot and other things are deemed to be not sexy. And so you're able to, there's more opportunities to buy it at low multiples. Right now, anything that's related to e-commerce, fast delivery of goods to consumers is very hot. And I wouldn't touch that with a 10-foot pole, not only because it's very competitive and the multiples are very high, but because that's an example of a kind of business where you have the most intense competition you could possibly imagine. If you're an e-commerce provider in India, you're competing against a SoftBank funded competitor. You're competing against an Amazon that's very active in India. They're investing billions of dollars there, and you're competing against Flipkart, which is Walmart. So you have some of the most deep-pocketed, long-term minded competitors you could imagine. They're completely content to not get much of a return out of those businesses while they crush their competition. So that's something I would avoid, and I would, devote most of my attention to the sectors that we've continued to focus on, which are the ones like industrial goods, capital goods, financial services, agricultural products and services, where they're serving they're serving demand that is really being created by economic development and by increasing prosperity. They're cementing their position in markets that are expanding rapidly, but also are where the competition is a lot more rational than it is in some of those hotter markets.
And Andre, what about the IT outsourcing world? I know that that is a big market.
Yeah, so that's over 10% of the Sensex is attributable to these companies like Infosys and Tech Mahindra and the like. And those companies, some of them might be decent businesses. The reason we've avoided them, and I really can't see us being shareholders in them, is first of all they're very well known to the type of big shareholder that we're differentiated from. So, they already sport multiples that I think are correspond to their underlying values, and I'm not sure exactly how AI will play out for them, but there's definitely a scenario in which they suffer because a lot of the work they currently have an advantage in doing due to India's low cost engineering talent. That may not be such an advantage when those things can be automated and brought home. And perhaps most importantly, their most important customers by far are in the US. And to date, services have not really been targeted by the tit for tat tariff wars, really by anyone. But one can imagine that suffering. And there's kind of already been a shot across their bows with the US limits on H-1B1s, which they're the heaviest users of.
Andre, you mentioned AI, obligatory, gotta ask you about it. You and my dad, not through Gymkhana, but have been paying attention to definitely that sector in the United States. What do you make of the extraordinarily large investments being made by Google, Microsoft, Amazon, Meta in order to build these data centers? And a huge percentage of that cash is going to Nvidia as well as some other companies.
Yeah.
Um, is it worth it? Is this going to be the dot com bust over again, or is this going to be great and the revenues are just going to go to the sky?
At the center of this AI boom, you have a number of companies that are spending tremendous amounts of money. Of course, OpenAI with these circular deals is a big concern. I think justifiably for a lot of people. The way that Farley Capital primarily, most importantly, is exposed to AI is through our investment in Alphabet. And Alphabet, I thought the people who were bearish on that stock earlier this year were missing the forest for the trees. Not to overuse that expression, but they really were. Where there was this obsessive concern with, well, aren't people going to switch from search to Chat GPT? And if you just observe the behavior of yourself and people you know, unless you're in some incredibly unusual niche in terms of people who just are addicted to ChatGPT, I don't see anyone shifting their behavior in terms of discovery on the web uh, in a way that's very commercially relevant. So, not when you're searching for information about a TV show, but when you're searching for information about the kinds of, a review of the sneakers you're thinking about buying, or a personal injury attorney. That's Google's bread and butter. And I think that's not going anywhere. And to the extent it does go the way of AI search, it'll probably be straight into the Google funnel via Gemini and all of the ways that they're perhaps belatedly, but I think very effectively addressing demand for that kind of product.
And so I know there are several different like KPIs that Alphabet Google tracks in terms of like paid clicks and cost per click. When you look at the fundamental drivers of the search business, which is the majority, are you seeing positive? Are you seeing green shoots?
The great thing about Alphabet's business is that they have every piece of the funnel. They have the compute in Google Cloud, so they're not relying on an external vendor for the compute. They have the actual index of essentially all the world's information. And people forget, but the world's second biggest search engine is also owned by Alphabet. It's YouTube. Uh, they uh, they also forget that anyone uploading video to YouTube is handing Alphabet a perpetual right to that video, and so they have control over the majority of video ever uploaded to the internet. All these disparate things that Sergey and Larry did over a decade ago, like buying YouTube, Google Maps. It all makes a lot more sense now, how it all fits together. And I think you're starting to see the payoff from that very long term thinking, where you have an entity that has these massively adopted over a billion, usually 2 billion plus user products like Gmail, Google Maps, and all that data that was scooped up, continues to be scooped up, is now the reason why a Gemini AI model, even if it's by whatever metric you want to track, quote unquote, worse than a competitor's model, it ultimately won't matter if it's able to deliver more effective, personalized, useful services to people by using that integrated silo of data.
What do you think about OpenAI, which is partially owned by Microsoft? Admittedly, Microsoft, bought it for a tiny fraction of what it's now supposedly
Yeah.
worth.
My sense, for what it's worth, is that Microsoft is doing everything it can. It's able to kind of suck the IP out of that entity, which, as you know, has a bunch of legal complexities surrounding it. And I think it made sense to for Satya Nadella to do what he had to do to avoid OpenAI and its team of very brilliant employees from slipping it into the control of a competitor. But when you're Microsoft, I think that's kind of only one part of your overarching AI strategy, and the rest of it has to do with stuff like Copilot and stuff that may be powered by OpenAI, but is not dependent on that partnership alone.
So if people want to access your research, we'll include a link to Maharashtra Scooters piece as well as your upcoming piece on India defense and aerospace. Andrei, where can people find you and find more of your work?
Yeah. So first of all, I really encourage people to check out gymkhanapartners.com. That's where you can find the blog that has the posts that you just alluded to. It's where you can find our latest materials, just explaining kind of what our strategy is and how it's performed. You can find me on Twitter/X. You can find Gymkhana there at Gymkhana Fund, and on LinkedIn. And I can provide you with links to pass along, because what I'm trying to do, at least on X, is to, if not tweet out all my thoughts day to day, at least I'm trying to retweet very smart people. So that hopefully should be an interesting follow.
Andrei, where's my retweet? I haven't seen.
Post something interesting
Okay.
and India related.
Okay. Yeah. So on Twitter, you are a Stetsen, ASTETSEN.
SEN.
Andrei, thank you for joining us. Thank
Thank
you
you,
everyone
Jack.
for watching. I hope you enjoyed today's episode. Looking to learn more about fiscal AI? Check out the link in the description to get 15% off any paid plan, including Fiscal's Enterprise tier, which is designed specifically for professional investors who need access to downloadable data. Until next time.